Hello everyone, and welcome to Net Diligence Virtual Cyber Risk Summit. My name is Heather Osborne, and I'm the Director of Global Events and Programming here at Net Diligence, a cyber assessment and data breach services company. We are pleased to extend our thought-leading content into the virtual space with this webinar series. Visit the conferences page on our website, www.netdiligence.com, to find out more about our online and in-person programs. Before we begin today, I'd like to extend our gratitude to our virtual cyber risk sponsors and our nearly 100 industry-leading speakers, without whom this program would not be possible. For today's webinar, we will be using the ON24 platform. Right now, you should be viewing the ON24 dashboard, which shows the live viewing screen and other features. During this presentation, all participants will be in listen mode only. Today's session is slated to take approximately 60 minutes. We welcome Pascal Millaire, CEO of CyberCube Analytics, and Stefan Golling, Chief Underwriter of Munich Re. They will have a fireside chat on reinsurance market conditions. Following their conversation, we will have a panel discussion moderated by Daniel Burke of Woodruff & Sawyer. The panelists will take your questions throughout the presentation. Simply type in your question and hit submit. Technical difficulties can also be managed through this feature. In the bottom corner, you will see a widget called Resources, where you can download assets our presenters and sponsors have provided. Just click on the resource and it will be automatically downloaded. If you are interested in receiving CLE or CE credit for today's webcast, please navigate to the CLE CE box in the lower right-hand corner to make your selection. This will ensure that you are emailed the CLE CE questionnaire to complete your application for credit. Additionally, please note that you must remain online for the duration of the program and answer the 3 polling questions that appear during the presentation. As a reminder, this webcast is being recorded. Following the conclusion of this webcast, you will be sent an archive link for further viewing or sharing with colleagues. This webinar will also be available on demand on our website. Again, thank you for joining us here at Net Diligence today. We hope you enjoy the program.
I have the great pleasure to be joined by Stefan Golling, Chief Underwriter at Munich Re. Munich Re is a leading provider of reinsurance, primary insurance, and insurance-related risk solutions, including in the cyberspace. At a virtual press conference earlier this month, Munich Re reaffirmed its commitment to cyber insurance and called out, and I quote, "Coverage for cyber risk remains one of Munich Re's most important strategic growth areas and fields of activity." Stefan, thank you for joining us.
Thank you, Pascal. Pleasure to be with you today.
Before we get to cyber, let's set the stage by looking at the outlook for the reinsurance market more generally. Munich Re's called out that there are stable levels of dedicated reinsurance capital, favorable pricing, in the context of low interest rates and also an economic downturn. From your perspective, what's the outlook for the reinsurance industry as a whole as we look forward to the next 12 to 24 months?
Yeah, look, I mean, on the outlook of the insurance and reinsurance industry, maybe let me comment as follows. I think there is quite some change going on these days, both in the insurance market as well in the reinsurance market. I think we're coming out of a period of continuous softening in the market from 2013 to maybe 2018, only stabilized maybe 2019, 20. We're coming out of a period of quite some severe NatCat years. So 17, 18, 19, we have seen a number of bigger hurricanes in the US. We have seen, I think, 4 quite large typhoons in Japan. We have seen other losses, so-called side perils, when you think about California wildfires, not only in recent years, now again. We have seen the wildfires in Australia, so a lot going on. And on top of those events, I think there's also some realization in the market that the current low interest rate environment will presumably stay for a while and will not change too soon. And on top of that, I think we have a number of factors that simply add uncertainty. On the one hand side, I think it's the US liability market with maybe some reserving uncertainty. Then, of course, when you think about current days, COVID-19, not only uncertainty for the insurance market, but uncertainty, I think, for all of us individually, but also simply as global economy. And then on top of that, if it wasn't enough, some systemic risks that are on the rise in our point of view. And pandemics is a good example. But today we will talk about cyber, certainly also a systemic risk that is increasing. And you could add, for example, also the climate change and the risk coming from climate change, but also the whole political environment at the moment with quite some civil unrest also. So I think these are a number of factors that have influenced the insurance and reinsurance market already, and they will further influence it. I think that will bring some discipline to the underwriters. And with increased discipline, of course, I expect clearly rates to harden, but also maybe not only on the price side some changes, also on the conditions. We think we can expect some tightening there as well.
Earlier this month, Munich Re estimated that it had a 10% share of a roughly $7 billion cyber insurance market, which clearly makes Munich Re a leader in this space. You've also publicly shared that Munich Re has a team of, and I quote, over 130 experts who develop cyber solutions for the entire value chain, from risk analysis and prevention to risk transfer. And that's in addition to your network of external experts and partners. I was hoping that you could comment about what's driving Munich Re's investment to secure this initial leadership position on the one hand, and on the other, given all of the uncertainty that you just mentioned, how an organization like Munich Re's continues that focus on this leadership position in a nascent space, given the uncertainties that are otherwise afflicting the broader insurance and reinsurance market.
Yeah, look, I think I'm proud to say that we accepted this cyber challenge maybe from day one. And I think we knew at that time, and we still know, that cyber is a challenge, a challenging risk, where we don't have 100 years of data like for so many other classes that we're operating in for many, many years, and that we will also face the one or the other, maybe even bigger or nasty surprise over the next coming years. But why did we accept the challenge? Actually, it wasn't too difficult because our clients told us loud and clearly what risks they are concerned about. And I think cyber in the last couple of years ranked higher and higher. So for us, it was really a question of, do we want to stay relevant as an industry? Can we really allow us to shy away from the cyber risk? And for us, it was clear that the answer has to be no. So if we want to stay relevant, we as an industry need to be able to offer solutions for our clients, not only us as reinsurers for our insurance clients, but really to the end customers. And that's exactly the reason, as you said, we have invested into our own people, the number of resources, but of course also the expertise. But I think also important, we have invested in partnerships with bigger tech companies, with smaller startup companies, with companies like yourself that of course can complement our own expertise and our offerings that we can bring then at the end to our clients. And I think overall, this is of course a journey. I think we are on a learning journey still. We learn basically every day. Also now during COVID-19, we've learned about cyber risk. But overall, I think we are well on track to develop a sustainable cyber insurance market overall as a whole market. And I think Munich Re, as you said, is well positioned, isn't it? I think our premium 2020 will exceed $700 million, which of course is nice. And if you allow me to maybe add a personal comment, how often in the times of an underwriter does it happen that you can actually develop a completely new line of business? Not only a one-off solution for an interesting problem of a client that maybe helps one or two customers, but actually a product that is really scalable. And that's just fascinating. And therefore, I'm also happy that I had the chance to be part of that journey.
You mentioned that there were a lot of learnings along the way. Let's get to COVID shortly. What have been some of the learnings from a Munich Re perspective on the cyber journey since you've accepted that challenge of insuring and reinsuring cyber risk?
Yeah, I mean, first of all, of course, we have seen that with the lockdown measures imposed by various governments, the industry had to react and had to change basically to a virtual setup, to business process being moved online, and that on rather short notice, and thereby maybe also the level of cyber risk has increased. So we have seen the amount of, or the number of attacks, cyber attacks, ransomware attacks, phishing attacks increasing. And that's certainly something that we have to be aware of, and where we have also to think about whether the market also on the cyber side has to react, has to harden, has to adjust maybe also premium levels there. On the other hand, it's of course also almost a boost to the cyber insurance market. I mean, with this increased level of digitalization, I think there also comes an increased need for cyber insurance, and that should help us actually on our journey to really develop that market in a sustainable way. When you think about very specific lessons, I would say I have two things in mind. First of all, I mean, we talk a lot about at the moment about wording ambiguity when it comes to business interruption losses following the lockdown decisions. And that's, of course, something that we have to keep in mind on the cyber side as well. How clear are our cyber wordings? How clear actually are non-cyber wordings, so the property wordings, property business interruption wordings, and how would they react after widespread business interruption following a cyber attack? And I think the second thing is, of course, having mentioned systemic risk beforehand, as we realize that on the pandemic side, maybe some risks are too high or too big to be covered fully by the private insurance sector. I think the same is true on the cyber side as well. When you think about widespread business interruption following whatever the failure of the internet or the failure of an entire power grid after a cyber attack, then presumably such a scenario also can't be covered by the private insurance market only.
So I'd love to hear a little bit more about what that might look like, that public-private partnership from your perspective.
Yeah. I think we need to be always, of course, careful when we call for these public-private partnerships, because, of course, it must be in the interest of the insurance industry to cover as many risks as possible by ourselves in the cyber market and to offer solutions for our customers. But we also need to dare to tell our clients, our customers, to explain them if a risk is just too big to be covered. We need to avoid the solution that we always and only react after such a big extreme event and then basically cry for support by government. So ideally, we prepare that before, and we have proven that in the past when you think about terrorism pools in some markets, even some nutcat pools in the market. Of course, there's always different reasons. And as we currently, of course, discuss on the pandemic side, that presumably for the biggest accumulations, we simply need a system where the vast majority of the losses is then picked up by governments.
I wanted to pick back up on the silent cyber business interruption issue. And this has been something that Munich Re has been driving the debate on this topic for quite some time. In fact, in July of last year, you were quoted as saying, the risks coming from the cyber peril clearly exist and affect all industries, markets, and companies, and that the goal should be to make cyber coverage non-silent, either by providing affirmative coverage or by covering it at least consciously. I'm curious if there were any kind of particular lessons learned from the pandemic 12 months later, and also your view on how the insurance industry is doing on cleaning up and making clear some of that potentially silent cyber language and policies.
Yeah, I mean, as I mentioned, I think there's an immediate lesson from COVID-19 where we see that original policy wording, but also reinsurance wordings have not been written in the best way to respond clearly to what we currently see in the market. And this is a typical form of non-damage business interruption. And of course, this is exactly the same when it comes to potential cyber attacks and the consequential business interruption losses. So I think our customers, first of all, have the right to know what is covered and what is not covered. But also it's neither good from a reputational perspective for the insurance industry if that is unclear. And let's be honest, from a risk management perspective, it's even worse when we don't know whether at the end we have the capital to respond to the losses that we potentially cover. How is it going in the market? I think markets have been addressing this, also of course forced by regulators who are asking for getting our heads around it. Has it been progressed quickly enough? I would say the pandemic almost tells us no, because I mean some policies maybe should have been cleaned up by the discussion on silent cyber that are now at least in doubt of responding to pandemic risk as well. So I think we need to improve there and actually focus even more on that. And let's not forget, only when we have kind of cleaned up the silent coverage, we actually can provide affirmative coverage and also can collect premium for that. So there should be enough motivation for the insurance industry to really tackle that challenge.
So clearly, Munich Re has been bullish on the cyber insurance market for quite some time, and it sounds like with the pandemic and the transition to remote work, Munich Re remains as if not even more bullish. But I wanted to think about some of the other demand-based lessons learned from the pandemic. I would note that in 2017, Munich Re established what was reported as the first dedicated epidemic risk solutions unit at a major insurer. However, take-up rates were reported to be quite low for that product. How do we ensure that cyber risk doesn't become another risk that enterprises need to buy but don't until a global systemic event?
Yeah, you're right. It was actually also around the time of Monte Carlo when we announced that we want to form this epidemic risk solution business as part of our overall innovation strategy, where we said there's a risk out there that is not really entirely covered. But as the name says, we wanted to focus on regional epidemics, not on global pandemics, because of the obvious accumulation risk, of course. And you're right. I mean, unfortunately, the market feedback was that there wasn't a high level of interest or acceptance of such a product. What were the reasons? Hard to say, of course. I mean, ideally, the customers would tell you, not us. But I would say there wasn't enough risk awareness of the pandemic risk. And maybe in that period, I mentioned before, there was a period of a continuous softening in the market. Maybe there was simply also not a preparedness to pay for risk that wasn't so obvious, that didn't happen every day. And there, maybe I'm hopeful that the starting point, of course, for cyber is differently. I think, as I said before, the awareness of the cyber exposure, I think, is bigger in the market with end customers. And if it wasn't realized so far, I think, again, COVID-19 is presumably the best reminder how important it is to be covered for business interruption. And therefore, this maybe should help us in better distributing the cyber product to the market. Of course, I think we need to be mindful of that we also there need to explain the coverage better, not only to customers, maybe even to brokers, so that the product is actually sold. And maybe we also need to think about how can we almost wrap the insurance product with some other add-ons like this, with prevention services, with recovery services, to make the overall kind of offering more interesting for end policyholders. And of course, no doubt, at the end, we need to be able to provide a competitively priced product, of course.
Looking forward, Munich Re has been pretty bullish about the continued growth of the cyber insurance market as a whole, and your company has estimated that the cyber insurance market will triple between 2020 and 2025. I'm curious what you think about the supply of reinsurance capital to support that growth, and what role alternative capital and alternative reinsurance capital might play in supporting the growth of the cyber insurance market.
Yeah, so you're right. I mean, we are continuously positive about the development. First of all, from what we have seen in the past years, it has developed already. I mean, we started 7 years ago with a portfolio of less than 100 million. Now we are at above 700 million. So there is growth in the past years. And we are continuously optimistic because of the overall focus on digitalization, maybe even the increased speed in digitalization, that there's simply a need for that product. As mentioned, I mean, there are risks involved in cyber that are maybe so systemic that the capacity of the market could come to its limits. So I think there is a demand also to think about alternative capital getting involved in cyber. I would say, unfortunately, we're not there yet. Maybe we see the first signals that the alternative capital is showing some interest also in cyber products, and I'm sure in a couple of years there will be more. And as you said, I mean, we certainly also have to talk about private-public partnerships to overall increase the capital base provided to the cyber product, but also, of course, to reflect that maybe some exposure also in cyber will also maybe be influenced by governments and their acting. I mean, it's one of the risks as well when you think about cyber war, where we have governments involved as well. So these kind of risks are always difficult to be covered, not only from an accumulation perspective, but also from a potential from a capability perspective, whether we can actually assess the risk coming from governments, and therefore maybe public-private solutions could be a good response to some parts of the cyber risk as well.
Fascinating stuff, and certainly a lot more important developments to come in the years ahead. Stefan, thank you so much for your time today.
It was a pleasure, and I look forward to an interesting day at the Net Diligence conference.
Thank you, Pascal and Stefan, for that interesting discussion. Hello, everyone. My name is Dan Burke, and I am a Senior Vice President and the National Cyber Practice Leader at Woodruff Sawyer. I'm here today with an esteemed panel to talk about reinsurance market conditions. Joining me today is Catherine Mulligan, the Global Head of Cyber for Aon's Reinsurance Solutions Group, John Merchant, the Managing Director at Optio Insurance Services, and Sandy Cotting from Swiss Re Corporate Solutions, who is the Global Head of Cyber and Technology. Thank you all for joining me today. So Stefan Golling just spoke with Pascal about all of the uncertainties which are affecting the global reinsurance market at the moment, whether it's multiple years of a softening market, reserving uncertainty in the U.S. liability market, increasing systemic risks, and a turbulent political environment at the moment. Specifically with respect to cyber, though, I think one of the things that I found from their discussion was, thinking about how these issues are impacting the reinsurance market. And Catherine, I'll start with you. Of all of those issues, which do you think are really impacting the reinsurance market?
Yeah, thanks, Dan. We've been talking about reserving uncertainty in cyber for a long time. So I guess it's an issue whose time has come. A lot of the loss activity that we've seen has been short tail. So I think overall, insurance space, there are questions about how to figure out the tail potential. When we're looking at insurers' portfolios, excess pricing, it's something that I think we've all been thinking about as being very competitive. And that's something that I think direct insurers are paying attention to. Also, kind of the differentiation between classes, that's something that's been limited. So looking at pricing adequacy overall, the models are still fairly new relative to other lines of business. And, I would say that cat loads are something in particular that are still being refined. So, the current conditions in other lines of business, that just really shines more of a spotlight on cyber. And so I think, reinsurers are looking at structures and pricing overall, and cyber is just a part of that overall hardening and attention.
And John, Sandy, have you guys seen these uncertainties and how they've impacted the reinsurance market? How is that really manifesting itself in the direct insurance market?
John here. I can take a quick tackle at that. Being at an MGA, what we're obviously seeing, reactions from our direct capacity providers as well as second-degree reactions from the reinsurers that are providing capacity. So, one of the biggest impacts we've seen are a lot more scrutiny around how we're going to do what we're doing. A lot more attention paid to the different segments of business that we plan to go after and what our plans are to ward off things like ransomware and social engineering. Kind of gone are the days of, and again, this is the right way to go about it, but gone are the days of wanting just an SME portfolio because that's low-risk business. We all know now that that's actually not the case. So there's just been, from our end, an increased level of scrutiny and deeper level of underwriting, and also an increase in the overall knowledge on the reinsurance side of these risks, and some concern, I'd say, on the potential for cyber to move more toward a long tail issue, especially with regulatory concerns out there that could change the landscape. So that's kind of my 2 cents on how this is impacting the reinsurance market.
Just to add on to that, this is Sandy. In terms of the direct market, a couple of trends that we've seen where coverage had been expanding on a regular basis every 6 to 12 months, new coverage is added. We've seen that stabilize, so the coverage is more status quo now, and we're also now seeing rate increases. At the beginning of the year, we were measuring rate increases of just a few percentage points, but that's accelerated throughout the year, and on a year-to-date basis, we're measuring it at close to a 15% increase in rates.
And so on that point about coverage expanding, do you think that is driven by sort of the market in general having this feeling of we've done this major expansion over the last few years, let's take a pause and figure out what's going on, or is it being more driven by, the losses that we see in the market are really ending up in a place where we've got pretty solid coverage from a wording perspective and we don't need to expand further?
Well, I can't give you the view of a reinsurer, but from a direct insurer perspective, I think it's a few things. Obviously, cyber exposure does evolve, so the coverage needs to evolve to keep up with it. Maybe that evolution of risk has not stabilized, but sort of paused with the ransomware epidemic, and everybody's trying to digest that and understand how the market should really handle ransomware. So I think that's one element, and then probably the other would be that we know that loss ratios are deteriorating. So I think insurers are probably wanting to pause as well and understand how they can restore profitability into their portfolios and not ready to expand the coverage beyond what it is when they don't feel that they're profitable with the coverage that they're offering today.
And Catherine, do you have a perspective from the reinsurance side, how they view the rapid coverage expansion over the last 3, 4, 5 years and sort of where we are currently with respects to coverage?
Yeah, so I would say that reinsurers have done a lot to invest in the space, so we see more specializations. I think that's a good thing that we have underwriters on the reinsurance side who are paying attention to what's driving the expansion, and so that does mean that there's more of a technical understanding of what the impact of that would be rather than just reinsurance support without such a deeper knowledge of the details. So look, I think overall we're going to talk about ransomware, and Sandy has already teed up the loss ratio discussion. I mean, what reinsurers will really need to understand is what's the strategy behind that expansion and what's the limits deployment plan. They're really going to want to understand it's okay if you have those expansions, but are you allocating premium? How often are you deploying the limits? What are the classes of business? And how are you just managing the overall capacity for those increased coverages?
If I could just add something quickly to kind of the discussions I've had over the years with reinsurers, seeing the evolution of the technical expertise and with particular emphasis on wording. A lot of the senior underwriters and bright individuals have had a high level of concern about language for years. There just weren't any losses to back up that concern. Now there are. So a prime example with that would be social engineering or invoice manipulation that leads to a crime loss. There's a lot of gray area in many policies about that. That was brought up by reinsurers years ago as what if, but there was no if happening. Now it's happening. So in my experience, they have been concerned for a while, and that is driving what Catherine was pointing to is a lot more emphasis on this, increased technical acumen around it, and very good questions scrutinizing. I don't care if it hasn't happened yet. If the policy language reacts in this way, how are you going to handle that?
Great. So considering that we're doing a virtual conference here, I think we'd be remiss if we didn't discuss the impact of COVID-19 specific to the reinsurance market. Catherine, have you seen an impact in the reinsurance market significantly yet from COVID? If not, do you expect it to impact it coming up?
Yeah, so I think the initial concerns of reinsurers kind of came in two forms. So the first was questions about the economic impact on cyber premiums and the potential for depressed growth, and then also what's the potential for increased claims. So on the economic side, the pandemic has certainly had an impact. So the questions then come in, has that slowed submission activity in the cyberspace? Have you had to change your premium growth projections? What's happening around the demand for cover overall? And, be curious to hear what Sandy and John have witnessed around that. We're seeing that clients are saying actually demand is still going strong. If anything, the pandemic has increased awareness in the larger account space for the need for increased limits. And then SME space, just the demand for cover overall, saying, now I'm realizing that there might be this exposure and maybe I should get some insurance. So premium growth projections don't overall seem to be impacted or changing. And I think, we can talk about claims, but what we're finding when we're actually doing a deep dive into what the activity is, what we're finding is that the story of COVID-19 is really just more of a new chapter in the ransomware story. This was already building coming into this year. So although the news cycles are reporting that COVID is impacting ransomware, the fact is that ransomware already was bad, and it's still bad, and it continues to be bad. So it's less of a COVID story than it is of a ransomware story. And we can talk more about that, but I'd be curious to hear what Sandy and John are seeing as well.
Yeah, this is Sandy. I can certainly give you our view on those two topics. On the economic front, we have not detected any reduction in demand. In fact, as you alluded to, if anything, there's an increase in demand. Of course, it's difficult to know what demand would have been like without COVID, but certainly in the SME space, any loss of demand from businesses going bankrupt or not having the dollars to buy cyber has been offset by increased awareness and an understanding of the need for cyber, especially as those businesses have now more distance workers. On the loss side, I think I would align with the way you were describing it, that we think ransomware would have increased anyway. It just happens that COVID is the ploy that is being used. If it wasn't COVID, they would have found some other topic to use as the hook for their phishing and social engineering. So we don't think that COVID is likely to have increased the rate of ransomware.
I concur with what everyone said. As a matter of fact, what we actually saw an increase in submission flow at the beginning of COVID, and due to all the factors pointed out by Catherine and Sandy, the one concern we would have, or I would have especially in the SME space, is the macroeconomic issue of bankruptcies occurring sometime next year. A lot of small businesses have been kept afloat. However, that will eventually end, and the recovery is going to be not a V-shaped recovery likely. And that could have a significant impact if there's a significant wave of bankruptcies sometime next year. But that's anyone's guess. Ransomware was getting worse, moving upstream to larger companies. If there's a silver lining in this, companies were edging toward work from home, edging closer and closer to larger percentages of their workforce working remotely. This acceleration has gotten them to realize perhaps how unaware a lot of their employees actually were of ransomware and social engineering and just cybersecurity in general. So hopefully that will have an effect on accelerating the awareness of this. Instead of being protected inside the corporate bubble, now they actually know when they've been hit because they did something wrong outside the network. There could be a plus there.
And Catherine, do you expect that we'll see COVID exclusions attaching to cyber reinsurance treaties?
Yeah, it's a great question, Dan. At the beginning of the pandemic, reinsurers across all lines of business were looking at exclusionary language, and some questions arose in the cyberspace, but we were able to have, I think, as a reinsurance community, a discussion about why that didn't really apply in this line of business, because as Sandy is describing, COVID is really just the hook. So if I'm going to click on an email or an attachment that's problematic, whether it has a COVID theme or not, that should still be a covered loss. So we're finding that those are not attaching to cyber. That's not the case with other lines of business, but for cyber. And if we did see that, I think we'd continue to push back. But, coming into 1/1, I'd say that the loss ratios were already increasing. We're seeing increased frequency and defense costs, and the severity as well is going up in terms of larger ransom demands. That's a concern. We're also looking at incident response actions can be hindered potentially by remote work settings. So I would just note that as a really important issue coming into 1/1, that reinsurers are overall looking to a hardening of terms, and the ransomware activity is a big part of that.
And that's a great transition, I think, into looking at the effect that ransomware has had on the reinsurance market. And you guys have touched on it a number of times already. And John, you said something interesting that I want to dive into, this idea of SME business, small business being this super profitable, never going to have a loss type of space. Are you finding that not to be true anymore, given what's happening with ransomware?
Oh, absolutely. So just the SME space in general, we go way back to the days of when cyber was born out of the E&O side of the business, and generally small businesses are seen as homogenous and quite profitable. You just write as much of it as you possibly can. Always underlying that they have an aggregate exposure issue because they use cloud providers, that sort of thing, and that was always a cat risk problem. But what we've also recognized is the SME space has limited resources, limited knowledge, limited awareness when it comes to a lot of cybersecurity issues. So that and that ransomware came right at the right time. These criminals are very intelligent. They understand this. They do their research. They get that they can go after the low-hanging fruit. And, there are, 24 million small businesses in the U.S., low penetration rate, but that's still hundreds of thousands, if not millions, of small companies that have bought cyber. So that has translated into that increased attritional loss. Now, it is forcing us as an insurer to look at all aspects of it, not just the underwriting, but loss adjustment expenses. Is there scope creep there? Can we manage that better? Can we provide even more services around education and awareness? That all comes into a plan that we would go back to our reinsurance partners with and say, this is how we're going to effectively lower our attritional risk, lower our overall severity. But there's a bit of a long road. But again, I go back to my point a little while back with the acceleration of awareness, because remote work, I'm hoping that helps quite a bit in this small space, because awareness is something that all of these small companies need. We're trying to provide it to them. It's just difficult sometimes to get that across.
And Catherine, what effect is this having on ceding commissions?
Yeah, so one thing just to build on what John was saying, that I would say that reinsurers really want to understand what's happening in a portfolio. So insurers can expect significant pressure on ceding commissions coming into fourth quarter and 1/1. They can also expect a deeper level of conversation. So really understanding what's the impact of ransomware on different segments of your portfolio, are the ransom demands increasing, and what's the breakdown of costs of these claims, how are these claims impacting your loss ratio overall, and even digging into some of those items that John was describing, so getting into a better understanding of what are the technology vulnerabilities that are at work kind of contributing to these claims. So I know that insurers are already doing this work to get their arms around what's happening, but the reinsurers are really looking to have a deep conversation about that. Still, I would expect pressure on ceding commissions overall.
And then Sandy, I think ransomware is obviously a big topic in all aspects of cyber risk at the moment. But I think there's a number of other things, other trends that are probably impacting things as well. You touched on one earlier around funds transfer fraud and social engineering. How do you see that sort of impacting the insurance market, if not the reinsurance market, at the moment?
Well, I can tell you that in our portfolio, especially our SME portfolio, fund transfer fraud is the second leading loss frequency cause. So it's definitely something that we're watching carefully. One of the things about fund transfer fraud that is unique is the ability to claw back the funds. So if you get the alert early and you jump right on it, you can often recover a high percentage of the funds. So that is a way to mitigate the losses, but it's certainly something that is on our list of loss trends to keep an eye on.
John, anything else that you've identified that you think is really impacting not only the insurance market, but the reinsurance market?
Not impacting yet, but on the radar is regulatory risk. It's, something we're keeping a close eye on, especially with potential upcoming change in administration in the U.S. Those sort of political shifts often change the pro-business, anti-business, wherever you land on that. That's something we're keeping a close eye on, and it's almost as if there's a race at the state AG level to write a broader law encompassing everything with private rights to action, et cetera. So CCPA, it all started years ago with GDPR, which didn't really turn out to be much of an issue, but I think CCPA is something that's up more concerning. Obviously, there's Illinois' biometric law. That could create really an entirely new loss trend that is long tail, and it's unique in that regulatory exposure is different, although similar, different than liability. So there's specializations there. So that's something we're keeping an eye on. We haven't seen, again, a trend yet. However, I shouldn't say no one, I'm sure somebody did, but I don't think anyone really anticipated ransomware just coming out of nowhere 18 months ago and then walloping everybody. What we're trying to do is make sure that doesn't happen again, and keeping an eye out for things like regulatory is the way we're going to do that.
And Catherine, I'll let you touch on this. Any other trends that you see really impacting the reinsurance market?
Yeah, so I would say that silent cyber is still an item that demands attention. As we've talked about many times, the UK Prudential Regulatory Authority and Lloyd's both took a stance in 2019 on this, mandating that insurers clarify coverage and also capture their overall exposure to cyber across all lines. And our experience is that carriers are still working on this. They're working to identify and quantify the exposure. It can be a long process. It takes a lot of people getting involved across different parts of the organization working together, and then also figuring out the quantification piece. So Aon, for example, has built a catalog of scenarios to help insurers quantify the problem. The modeling firms have been working on scenarios. So overall, insurers need to get their arms around the exposure so that they can then figure out how to get it in alignment with their overall corporate risk tolerance level. So this isn't something that just happens. And I would say that reinsurers can help with clash cover as insurers are transitioning policies. It's very important that an insurer has a really good understanding of what their strategy is and the timing of it and the different milestones. So whether you're going to affirm or exclude cover, just whatever the plan is, how you're going to allocate premium, whatever it is, you just need to be able to articulate that and articulate the rollout schedule. Additionally, I'd say reinsurers will need a deep understanding of your empirical analysis of the exposure. So we do see, in terms of structures, the support has primarily taken the form of cross-class, aggregate, or event excessive loss solutions. In picking up different lines of business, a lot of times there is some affirmative exposure as well as the non-affirmative kind of built in there. So that's something that's still moving along.
Thanks. And so switching topics a little bit here. It seems as though these days you can't run around without running into another cyber MGA. So Sandy, in your role as a direct writer at Swiss Re, you guys have obviously made the bet on the cyberspace by backing Coalition. I wanted to get your thoughts on sort of what you're looking for when you're considering backing an MGA, the types of issues you're going to be focused on.
Yeah, we could spend a lot of time talking about that, but let me try and hit some of the high points. First of all, we were looking for some balance and diversification in our portfolio, and the piece that was really missing was the SME and some of the middle market. So that was our primary goal. Now, to get into those segments, you really need efficiency because you need high policy count, so you have to do it in a low-touch method. So when we looked at Coalition, we were looking at their technology in two elements. One, their digital platform to enable efficient processing of business, and two, their technical risk assessment tools. And we have in-house risk engineers who are experienced cybersecurity practitioners. So they helped us with evaluating Coalition's technology solution, their risk assessment tools. So that was a big part of our review. But we also went beyond that because we were looking for a more holistic solution, not just an insurance solution. So we really liked Coalition's broad service offering that they start with risk management. They provide a risk assessment report to every applicant that if you buy a policy, you get ongoing monitoring. So if a vulnerability is detected during the policy period, Coalition will alert you to that so you can patch it before it becomes a problem. And then on the backside, if you do have a loss event, Coalition has in-house incident response. I mentioned in the fund transfer fraud discussion how important the timeliness of responding is. So we really like that they can respond within minutes or hours of being notified of the loss. So that whole package of service offerings. Now, that's all great, but if you don't have submissions, then none of that really counts. So we also looked at their distribution plan, and we think they've really done a great job in building out their distribution network so that they are driving business into the platform. Again, I could talk a lot about it, but those are a lot of the key things that we were looking for and thinking about when we decided to back Coalition.
And John, obviously you're at an MGA now at Optio. You know, I hear these stories about MGAs having a harder time these days finding capacity than maybe, 3-4 years ago. Is that true? And if so, what do you think is driving that?
Actually, I wouldn't say it's true. Again, in my experience, there are the traditional usual suspects to provide capacity are arguably somewhat tapped out, but there are a lot of new entrants in the market that are looking to expand, looking to allocate their capital and get some return on it, still believe that there's a profitable growth upside in cyber, and therefore are more than willing to have a substantive discussion about capacity. So it's not constrained, it's just expanded a bit, actually, and altered. So to Sandy's point too, I mean, each time we're in a constant search for additional capacity. Any NGA that has to be a part of their plan is you're always looking for potential new partners. And the original point of all this with capacity in the reinsurance and the direct side is the increased scrutiny and questioning around how you're doing what you're doing. So it's a challenge, because there's a lot of new MGAs coming up looking for capacity, but it's been somewhat buffered by alternate and additional capacity out there in the marketplace, and working with the right partners to find that capacity and line up strategically with what they may be looking for, because no two capacity providers are the same. Some are looking for distribution, some are looking for access to different markets. They're all a little bit different, so to come in with a homogeneous plan doesn't really work. You have to come in with something much more focused and then be aligned with the right partners that are looking for the same thing.
Yeah, no, I love those comments, John. I think you bring up some really important points. I mean, maybe, Dan, what's kind of contributing to the feeling of that difficulty is when the kinds of things that John is describing are maybe not as fleshed out as much. So when it can be difficult is when there's channel conflict. So Sandy described this very well, saying, okay, I had a strategy and I wanted to fill this part of my cyber strategy, and I've decided to partner with somebody who could fill that for me. But if you don't have a clear vision that way, then it can be hard, because an MGA might say, well, I want to write small business, for example, and the partner carrier might say, yeah, but I've already got my own small business strategy, so I've got a channel conflict. Or even if you work with a fronting carrier, they might say, well, I already have a cyber partner, so I can't have another one. So you've got to watch for channel conflict. Another thing that we bump into is, I would just say, misalignment of expectations or management of expectations, particularly on timing. So it's terrific to have a lot of enthusiasm about, getting up and running and, starting to write business right away. But I would say that it always takes longer to get going than expected. So just from the nuts and bolts of the process of getting NDAs signed and setting up first conversations, that alone can take weeks. So it's always just something to plan that it will take longer than you think. And then the other thing that both John and Sandy talked about is differentiation and this idea of a technology platform. So I think it's amazing that we've seen so much evolution in this space of having a technology platform for those efficiencies and some really great risk management recommendations and reports that can come out of that. But being able to express how your technology platform is different it can be difficult in this market because there's a lot of conversation of, I have technology, and so you really want to make sure that you can say how and why yours is different, just to make yourself stand out as you're marketing your MGA proposition.
And that's, I think, a really good transition into sort of the process that people are going to go through. They're looking to buy reinsurance. John, any thoughts on sort of advice you might give someone who's in the reinsurance process or starting up an MGA, sort of what to expect?
Yeah, I think one of the biggest things that jumped out at me, and what I really like about where I am now, is our ability to extract data and present it in multiple formats. So essentially, we have a great data warehouse that encompasses not only underwriting, but more importantly, probably on the claims side. So there's a lot of legacy carriers that are sitting on a tremendous amount of data, but they can't extract it into any sort of actionable information. As an MGA, we're set up with a technology platform, an internal one, and it's a platform that allows us to pull that data out and then present it very quickly. It shows that we're on top of that, and I view Optio heavily as a data company, and we're able to use that to make underwriting decisions, to make better claims decisions, to identify trends. If someone was going out into the market as an MGA or anyone just trying to have discussions with the reinsurance marketplace, I can't speak for all the reinsurers, but I can tell you if you show up at the front door with a lot of data and that data is showing insights, trends, and you have access to it, kind of turning dials and pressing buttons, and you can get great extracts, that is a great way to move yourself ahead of other folks in the line who may have a tremendous amount of experience and understanding of the marketplace, which is obviously important too, but aren't able to make quick data-driven decisions because their platform isn't built like that.
And that's, I think, great advice. Obviously, as insurance people, and I think we would all have the advice of, get out early and having a good grasp on sort of the trends that are happening, like ransomware. Catherine, I want to touch base with you real quick on sort of creative ways to transfer risk. Are you seeing anything really creative out there on the reinsurance side in new ways to transfer risk?
Yeah, thank you. And if I could put a really fine point on everything that John just said, get out early and have a really good grasp on your data, particularly having good claims data. That's going to help a lot. In terms of creativity, so I would say that most of the market is still in a quota share kind of universe, but we are seeing London in particular entertaining more non-proportional structures. So cedents are using quota share to control frequency, severity, kind of volatility of the class. But we have seen increased interest demand for proportional solutions, principally aggregate excess of loss and stop loss structures. So that is something that I think is evolving. And then kind of further down the line is the insurance-linked security space. So, right now in the retail market, there's, I would say, about $1 billion in theoretical capacity available for a single enterprise commercial client. And so what we're finding is that there's eventually going to be pressure. While there's reinsurance capacity and it's available now, eventually there will be pressure on that. And we're hopeful that cyber will find its way into the alternative capital market. So we've already seen some collateralized re transactions. But ILS in general, it really feels like a natural home for emerging risks like cyber. And some investors have already said, yeah, we're keen on emerging risks. We're willing to work with you to build an understanding. They do have a concern about correlations with the financial markets. And this overall underscores the importance of modeling, which is kind of always important, but it's essential in the ILS space. So the reinsurance community is already doing work on building better models and deeper understanding. So that's going to have to continue. But I think that's something that we're hopeful will be, not too far down the track here, something creative and some new capacity.
So to wrap up, we've got about a minute, but Stefan, at the end of his interview with Pascal, mentioned public-private partnerships. And I think to me that really boiled down to a desire for a stable cyber insurance market that can continue to grow. So as closing thoughts, I'm going to ask each of you to touch on, sort of from your perspective, how can we maintain a stable cyber market in just a few words or less. Sandy, I'll start with you.
Sure. We've talked a lot about ransomware, so solving that is going to be an important issue. I don't know if that means we stop paying ransoms and the coverage is better for the consequential effects of not paying the ransom, but we have to solve that. And then the second one we haven't talked about too much here, but that's the aggregation risk. So a single event that touches a huge proportion of cyber policies. And I think that's probably an area where you need more of a public-private partnership with government backstops and things like that.
John, your thoughts?
I'd say on the just coming from an underwriter, discipline helps quite a bit. I think there was a lack of discipline, quite frankly, over the past few years, which may have fueled some selling by price only. So some introduction of just general discipline will stabilize the market or just send it back in the appropriate direction. And then, yes, the public-private partnership I think is incredibly important. I honestly don't have tremendous high hopes for that, as they've been trying, or we've been trying to do that for probably over a decade now. And it seems to stall over and over again. But if there's some sort of information sharing mechanism to allow both sides to be comfortable in sharing that, then I think that would be a tremendous backstop that would foster a lot of growth in the cyber market, profitable growth.
And Catherine?
I would say I really appreciate everything that the reinsurers are doing to invest in their technical expertise in this space, and I would just ask that it continue, because we do need reinsurers to remain steady and focused on the issues. So without kind of reacting to each new claim or each new issue, they already demonstrate great partnership with insurers. And so kind of take the long view and keep calm and carry on.
That is all the time we have for today. I'd like to thank Catherine, John, and Sandy for your comments today on the reinsurance market conditions. For those of you that submitted questions, we will make sure we follow up via email. Thank you again. Have a great day.